how to safely diversify your investment portfolio with cryptocurrencies. Cryptocurrencies have generated average annual returns of over 100% in the past decade, but they've also seen drops of 80% or more. So how do you harness their potential while protecting your financial future? Today, we're breaking down a science-backed approach to adding crypto to your investment portfolio without gambling your retirement away. I'm going to share institutional-grade strategies that major investment firms actually use, backed by data from the last 10 years. But first, let me be crystal clear. This is educational content, not financial advice. Always consult with qualified professionals before making investment decisions. Chapter 1. Understanding cryptocurrencies. Let's start with the basics. Cryptocurrencies are digital assets secured by cryptography and typically built on blockchain technology. Think of blockchain as a distributed ledger. Instead of one bank keeping track of transactions, thousands of computers worldwide maintain identical records. According to CoinMarketCap data, the total cryptocurrency market capitalization grew from under $18 billion in 2017 to over $3 trillion at its peak in 2021. But here's what most people miss. This wasn't steady growth. The market experienced multiple boom-bust cycles, with Bitcoin alone dropping over 80% from its highs 3 separate times. Conclusion: volatility is the rule, not the exception. The Federal Reserve Bank of St. Louis published research showing that while cryptocurrencies offer portfolio diversification benefits, their correlation with traditional assets increases during market stress, exactly when you need diversification most. This is crucial to understand before we discuss allocation strategies. Quick question: have you ever invested in cryptocurrencies? Drop a comment and let me know your biggest concern about crypto investing. Chapter 2. Risk minimization and security practices. Security in cryptocurrency isn't just important, it's everything. Unlike traditional investments where regulations protect you, crypto operates in a largely unregulated space where your security decisions determine whether you keep or lose your investment. First, understand custody. Hot wallets are connected to the internet, convenient but vulnerable. Cold wallets are offline storage devices, less convenient but significantly more secure. A 2022 Chainalysis report found that cryptocurrency theft totaled $3.8 billion, with the majority involving compromised hot wallets or exchanges. Finding: never invest more than you can afford to lose. Here are non-negotiable security practices. Use hardware wallets for long-term holdings. Enable two-factor authentication everywhere. Never share private keys or seed phrases. Use reputable platforms with strong security track records and insurance coverage. And critically, start small while you learn these systems. The Mt. Gox collapse in 2014 lost 850,000 bitcoins. The FTX bankruptcy in 2022 affected millions of users. Even established institutions aren't immune to security breaches. This is why financial advisors recommend treating cryptocurrency as a high-risk, high-potential reward asset class. Chapter 3. Portfolio allocation strategies. So, what percentage of your portfolio should be cryptocurrency? The answer depends on your risk tolerance, age, and financial goals, but research provides some guidance. A 2021 study by Fidelity found that institutional investors allocated an average of 7% to digital assets. However, most financial advisors recommend retail investors limit crypto exposure to 5 to 10% of their total portfolio. The reasoning is mathematical. Even if crypto goes to zero, you can recover from a 5 to 10% loss. A 50% loss is potentially devastating. Observation: 5 to 10% allocation equals significant upside, manageable downside. Yale's endowment fund, managed by David Swenson, allocated up to 10% to alternative assets, including cryptocurrency. But here's the key insight. They treated it as a separate asset class within their alternative allocation, not as a replacement for stocks or bonds. Consider your crypto allocation part of your speculation or high-risk growth bucket. If you're young with stable income, you might go toward the higher end. If you're nearing retirement, the lower end makes more sense. The critical rule: never allocate money to crypto that you need for essential expenses or retirement security. Chapter 4: Historical Performance and Strategies. Let's examine what actually worked over the past decade. Bitcoin, as the largest cryptocurrency, provides the most reliable historical data. A dollar-cost averaging strategy, investing the same amount monthly regardless of price, significantly outperformed lump-sum investing during volatile periods. According to data from Bitcoin's price history, investors who used dollar-cost averaging from 2014 to 2024 achieved better risk-adjusted returns than those who tried to time the market. The key insight: volatility becomes your friend when you're buying consistently over time. This means that diversification within crypto matters too. Within cryptocurrencies, diversification also mattered. A portfolio split between Bitcoin, Ethereum, and smaller altcoins outperformed Bitcoin alone during certain periods, but also experienced higher volatility. The sweet spot appeared to be 60 to 70% in established cryptocurrencies like Bitcoin and Ethereum, with 30 to 40% in carefully researched alternatives. However, during the 2022 market downturn, cryptocurrencies fell alongside stocks, challenging the diversification thesis. This reinforces why allocation size matters. Crypto should enhance, not dominate, your investment strategy. Chapter 5: Risk Factors and Realistic Expectations. Let's address the elephants in the room. Cryptocurrency investing carries unique risks that traditional assets don't face. Note: regulatory risk is real and evolving. Regulatory uncertainty remains significant. China banned cryptocurrency trading entirely. The US continues developing frameworks. The EU implemented comprehensive crypto regulations. These decisions can cause overnight price swings of 20% or more. Volatility is extreme. Bitcoin has experienced 5 separate drawdowns exceeding 70% since 2010. Ethereum dropped 94% during the 2018 crypto winter. Smaller cryptocurrencies regularly lose 95% or more of their value and never recover. Market manipulation concerns are valid in this relatively small, unregulated market. Liquidity can disappear during stress periods. Technology risks include smart contract bugs, network failures, and quantum computing threats to cryptographic security. Remember, past performance is not equal to future results. The spectacular gains of 2010 to 2021 may never be repeated. Cryptocurrency could become a mature, lower-return asset class or face existential challenges from central bank digital currencies or regulatory crackdowns. Conclusion. Here's the balanced approach. Treat cryptocurrency as a small but potentially meaningful part of a diversified portfolio. Start with 5% allocation if you're risk-tolerant, less if you're conservative. Use dollar-cost averaging to reduce timing risk. Prioritize security above all else. Stay informed about regulatory developments. And never invest money you can't afford to lose completely. Remember, successful investing is boring. It's about consistent contributions to diversified portfolios over decades, not hunting for the next 1,000 times return. Cryptocurrency can play a role in that strategy, but it shouldn't define it. Share your thoughts on cryptocurrencies or investments in general in the comments. If you would like to receive more content like this, or if you would like to help others find this channel, please subscribe.